Silver just erupted up to $83 and then collapsed back toward the mid-70s. If you thought you were early, you weren't. What you saw on the screen was only half the story. Today, we're breaking down what really happened inside the silver market, the structural stress, the extreme volatility, and why paper prices and physical metal are sending very different signals right now. Let's go. Before we go any further, it's important to understand the context of this move. Markets don't surge and collapse in isolation. They react to pressure that has been building quietly, often for months, sometimes for years. When price finally moves, it's not creating new information, it's revealing information that was already there. Silver had been coiling, volatility was compressed, inventories were thinning, and positioning across futures markets was increasingly one-sided. So when price finally broke higher, it didn't drift, it launched. That kind of behavior tells us the market was already unstable before the headlines ever appeared. Over the past several days, silver surged aggressively across global markets, pushing into the $82 to $84 range. Momentum exploded. Charts looked unstoppable. Headlines turned bullish. And then, just as quickly, price snapped back. Silver dropped several dollars in a matter of hours. This wasn't a slow pullback. This wasn't normal consolidation. It was a sharp reset. Moves like this don't happen in calm, balanced markets. They happen when liquidity is thin, inventories are tight, and positioning is stretched. In simple terms, the silver market is no longer moving smoothly, it's lurching, and that tells us something important. When markets begin behaving like this, it's usually a sign that price discovery is struggling. In healthy markets, buyers and sellers meet smoothly. Price moves gradually as information gets absorbed. But when liquidity dries up, price stops being a negotiation. It becomes a reaction. Every order matters more. Every headline hits harder. Every imbalance gets amplified. That's exactly the environment silver's operating in right now. To understand the size of this move, you need to understand two forces colliding. First, physical tightness. Inventories at major pricing hubs have been drawn down significantly. When available metal is thin, prices become hypersensitive. Small buying pressure creates big moves. Small selling pressure creates sudden drops. Second, speculative positioning. As silver began rising, traders rushed in. Momentum strategies activated. Volatility traders piled on. That combination, tight physical supply and aggressive speculative demand, creates a market that moves fast and violently. This wasn't about one report or one headline. It was about a system already under stress finally reacting. Here's where the real story begins. Silver doesn't trade in one market. There's paper silver, futures, ETFs, derivatives, contracts, and there's physical silver, actual metal that can be delivered, weighed, and held. Right now, those two worlds are drifting apart. In recent sessions, physical silver in major hubs has traded at premiums relative to paper contracts. That matters, because when physical metal becomes harder to source, paper pricing loses authority. This condition signals stress. It tells us the market values immediate access to silver more than future promises. And when access becomes the priority, price discovery changes. This stress didn't appear overnight. Silver's physical market has been running structural deficits for years. Unlike gold, silver production can't easily ramp up. Most silver is mined as a byproduct of other metals. So when demand rises, supply doesn't respond quickly, and demand has risen. Solar energy, electric vehicles, high-efficiency electronics, data infrastructure. Silver is no longer just a precious metal, it's a strategic industrial input. That combination, rigid supply and expanding demand, creates tension. And tension shows up as volatility. Now layer technical mechanics on top of that structure. Thin liquidity means large orders move price more than usual. Extreme volatility exaggerates breakouts and accelerates reversals. And when futures margins increase, leveraged traders are forced to exit positions quickly. That forced liquidation adds fuel to downside moves, even when the broader fundamentals haven't changed. So the rally toward 83 wasn't just enthusiasm, and the pullback wasn't fear. Both were symptoms of a market operating under stress. Here's the key takeaway. This wasn't just a spike and a crash. It was a warning. It tells us that silver is entering a phase where breakouts can happen fast, retracements can be sharp, and headlines can move markets more than usual. More importantly, physical availability is starting to matter more than paper pricing. And when that happens, price becomes less stable, but more revealing. So if you thought you missed the move, what you really missed was the deeper signal, the disconnect between paper and physical silver, the shrinking inventories, the structural pressure building beneath the surface. Silver doesn't just fly and crash randomly, it reacts to imbalances. And understanding why it moves is far more powerful than chasing where it moves next. If you want clear, calm breakdowns of global markets like this, not hype, not noise, subscribe and stay tuned. Because the most important moves usually start long before the crowd notices.